We are so screwed, man. It's all over. I know you've been hearing this a lot on your timeline, but is it true? Look, a lot of people got liquidated recently. It hurts. A lot of people lost all their money in meme coins. It hurts. Did we just miss selling the top, though? Are we entering a new painful bear market? I don't think so. Before you panic, let's look at the data, decide at the end of this video. Bitcoin and crypto as a whole are considered, of course, risk-on assets. These are investments that investors are more likely to buy when they feel optimistic about the economy and are willing to take on some more risks. On the flip side, when investors, of course, are feeling uncertain about the economy, guess what? They tend to turn risk off. They go for assets like bonds, gold, just holding straight dollars or US treasuries and stuff. It's, the safe bet. And you know what else are considered risk assets? Stocks. This is the reason why analysts have been trying to look at the correlation between the stock market and Bitcoin. And of course, there's always a correlation between Bitcoin and the rest of our crypto coins, okay? Bitcoin is our North Star at the end of the day, which is why we talk about it so much and chart it out and discuss its relation to everything. Now, one of the easiest ways to spot this is by looking at the correlation coefficient between Bitcoin and the S&P 500. Now, TradingView is a correlation coefficient indicator which shows how assets follow each other. Now, the rules here are pretty simple. The number ranges from -1 to +1, wherein a value of +1 indicates a perfect positive correlation and a -1 indicates a perfect negative correlation. Now, in this chart, we can see that the correlation coefficient has been above the 0 line more than it is in the negative territory, meaning, of course, that we are more correlated with the stock markets. That's the conclusion that we draw. Bitcoin largely follows along what stocks are doing. Stock investors look at Bitcoin as a higher beta play for the stock markets. ETH is a higher beta play of Bitcoin, and so on and so forth down the line until you get to dog coins. But I have a diverging opinion on this one. If you think about it, Bitcoin actually dips on crypto-specific news while the S&P 500 continues its upward trajectory. But then if we get bad macro equity news, Bitcoin also dips. You basically dip all the time. For example, in July 2021, the correlation value was -72. Going back, this was the time when China banned crypto mining. So we have lots of sector-specific headline risk in crypto, as you probably know. So instead of drawing the conclusion that Bitcoin perfectly follows the S&P 500, it's more likely that both of them are being influenced by the same factors like geopolitical conditions, market sentiments, monetary policies, liquidity in the system, inflation, all that kind of stuff. So just have a look here at the charts. The bottom of the market for both the S&P 500 and Bitcoin is actually during the peak inflation of 2022. Bitcoin correlated very heavily to the risk-off environment that took over the equity markets. Now, we have to remember, too, of course, that the Fed is going to use all the tools at its disposal to try to hammer down inflation back to around 2%. Raising interest rates has been the favorite strategy. They did that for a long time. Now we're cutting interest rates. But if inflation goes too high, if it gets out of control with the tariffs or any of this other stuff that is spooking markets out, then the most contrarian thought would be that we get rate hikes this year. Now, raising rates will make it harder to borrow money, probably send panic through the markets, just simple stuff, makes it harder for businesses to raise capital for expansion, all that kind of stuff, but it would just signal economic problems. The subsequent slowing of the economy would also result, of course, then in lower inflation, which would make the Fed then eventually cut rates, but that we'll watch later on. This also limits the money available to risk on assets like Bitcoin and stocks. Since, of course, we're nearing the target of 2%, the Fed has been keeping rates steady at 4.25 to 4.5%, but inflation has been slightly ticking up recently, which is problematic. Now, if inflation behaves and starts cooling back off, then we still have a lot of fuel left in the tank. But if we see massive spikes in inflation, that's a problem, but it hasn't happened yet. Another indicator, of course, to look at, again, I know what I was talking about. We're going to take some different nuance here, is the M2 money supply. Before we get into that and break that down, if you're a crypto trader, I got a crazy deal for you. Femex right now is running a crazy sign-up bonus. So it's one of the top crypto exchanges. They've been around for years, okay? And it's one of the top places to be trading all the top coins. One of the exchanges I use quite a bit. And it's available to everyone, everywhere, right? Making it a great choice for traders, no matter where you are. Here's the deal. You'll get $50 for free. Yes, $50 for free when you use the link down below to start your account. That's crazy. That's just a straight up crazy sign-up bonus. Go check that out. Then you can also get a 20% deposit bonus. You deposit $1,000, you get $200 back. and you'll get up to $1,000 trading bonus. Now, this is a limited time offer. Click the link down below to get started today. Go check it out. Okay, so let's take a little more nuance on the M2. We've compared it to a few different charts here, but let's take a little bit of nuance here. The M2 is the measure of the global money supply, including cash, checking deposits, saving accounts, money market funds, all that kind of stuff. All the money in the system, essentially. Now, in short, that's all the dry powder that's out there to pump up your bags, all right? The more M2 in the system, the more dog coins are going to go up in price. So far, the M2 has been steadily rising. Its growth has been pretty damn insane since the pandemic days and actually hit a 27-month high at the end of 2024, followed by a correction, which led to a slowdown in market momentum. As I'm sure you've seen recently, Bitcoin kind of started ranging sideways when we pulled back a little bit on the M2 and all of our altcoins went to zero. Well, not zero, but down enough to feel the pain, right? This accelerating money supply, though, is starting to tick back up, and it's an indication that the economy has a solid foundation, and a decline is usually bad news, a major decline. Short-term pullbacks are fine, that happens, but from the start of 1870, there have only been 5 times when M2 fell by more than 2% or more on a year-over-year basis: 1878, 1893, 1921, 1931, and 2023. Historical times we live in, guys. Think about that. It's almost 100 years since that happened last. All 4 before 2023, by the way, were depression years. No depression this time, although there has been some economic woes in America, but those seem to be passing. The storm seems to be blowing away. 2023 was an anomaly, and the U.S. did defy constant predictions for a recession to happen. The most advertised, telegraphed recession never happened in the history. So is that indicator broken? Well, not necessarily. We're 4 out of 5, and let's worry about a recession later when the M2 starts pulling back. And there's other things that say a recession could be coming, you know, the yield curve uninverting and stuff like that, but maybe this is the time that the Fed really pulls off the soft landing. But for now, there's still a ton of dry powder in the market, a lot of money in money market accounts and stuff like that, which means there's a lot of money for risk assets like crypto. Also, we've got a lot of good news. The U.S. economy is right now considered to be in the Goldilocks Zone, which is very, very interesting. It's hard to feel like there's going to be this imminent super mega recession, everything's going to go to zero based on the current economic situation. And in case you haven't noticed, we largely trade as some kind of proxy for the U.S. economy, right? Because it's the most powerful economy in the world, the Fed dictates the global terms of money. Right now, the economy's not too hot, it's not too cold. I know it sounds a bit like a fairy tale, but inflation, it's manageable at the moment, okay? 3% is fine. The economy is not too hot. It's growing around 3%, right? It's fine. The GDP registered a 2.3% growth last quarter. Things are good. Not too hot, not too cold. Yeah, I know that's a decline from the 3.1% of Q3 2024, by the way, but it's still 2.3% growth. It's pretty good. Not too hot, not too cold. Now, how long will we be in this particular zone? Obviously, is anybody's guess. But as long as we remain in this Goldilocks zone where inflation's not going too high, rates are not too high, economy's doing good, people have jobs, unemployment's near record lows right now, we can expect that we'll still have a bit more time for this bull market cycle to run. And we're not screwed for now. We will be later. An end always comes. And of course, we're in crypto. We tend not just to look at unicorns and rainbows, although somebody's probably already making the unicorn rainbow meme coins. That's besides the point. If there is anything we've learned in this market is that we must balance our views with the good and the bad. Now, in 1995, we had internet tech companies which started to make a really big impact and to make gargantuan gains as they made names for themselves. Investors, they were rushing, man. They wanted to buy all these shiny new things. They wanted to get these hot new internet stocks. Now you fast forward to the year 2000. If you know your history, or if you're just old, congratulations, you're old. I was a teenager back then. Besides the point, the dot-com bubble popped and the unlucky ones were left holding a collection of worthless bags, trash websites, and a few, of course, lucky investors were left holding Amazon stocks or Apple stocks, but they had to deal with a lost decade in terms of return-wise, especially if they top blasted. Now, we're in a very similar parallel at the moment with the AI boom. A lot of people comparing this to dot-com bubble, and there's a lot of good parallels, although the adoption curve may be going crazier and the exponential nature of AI may make it more sustainable long-term, but we're definitely seeing a bubble expand here. It's not popped yet, though, so still has time to go. Some people think that bubble's going to pop in 2025. Maybe. Maybe it doesn't pop till 2026. Man, the most contrarian point of view would be we have a 2-year bull run ahead of us. It's exhausting, man. We also have to worry, of course, about Trump's 4D chess stuff. If he pushes through all the tariffs, then it's bad news for everyone. But maybe, just maybe, they get enough other countries to pull back their tariffs and things mellow out. Now, you might think this would only affect people outside the USA. The world's biggest economy would be fine, but consider this, of course, tariffs imposed on smaller economies can also lead to higher prices for imported goods, particularly for stuff like commodities, okay, which is what everything's made out of. Now, that could, of course, then end up causing some form of economic slowdown, of an economic turndown, especially for smaller businesses and smaller economies. But that hasn't happened yet, and that may not happen. That's the thing to keep in mind. It may not happen. You might have enough people removing their tariffs on the U.S. to make it all even out. You might have enough tax cuts, enough stimulus, all that kind of stuff. Now, according to a study by the Peterson Institute for International Economics, tariffs on China, Canada, and Mexico, who, of course, by the way, are the United States' biggest trading partners, those tariffs would potentially cost the typical U.S. household over $1,200 a year. That needs to be offset, or it causes an inflationary crisis and average families feel more pain. Now, there's been a proposal from the Department of Government Efficiency of a $5,000 tax refund from the money that they're saving from all the waste and fraud in the system. It's another topic altogether. There's Trump proposals for big tax cuts, which, again, could help out those households. But all this stuff long-term can cause a lot of problems in the economy. Short-term, probably really good, pumps up the markets. 2 or 3 years down the line, let's see how we go. Now, this is all important since the less money a household has, of course, translates to less money for investment instruments like stocks, Bitcoin, and dog coins. I know we've discussed that inflation is still manageable. However, it does seem to be slightly going up from previous months, and that's not fantastic. It's not the trajectory that you want to be on. You want to see it go in the other way, and that's a bit worrisome. But according to a prediction from Vanguard, one of the top asset managers in the world, they're saying that the core inflation should land between 2.1 to 2.4% later this year, that this short spike around certain fears and things that are going on in the market, probably not going to be a big deal. Core inflation is going to go down a whole percentage point, which is good. So no need to sound the alarm yet. We are not screwed. We still have time in the cycle. The conclusion here, I still stand on the side, the bull market, far from over, mid-cycle to late cycle, okay? And this is a different angle from the video we just did talking about the similar topic, but this is the macroeconomic side, okay? Market cycle might even run in 2026, which would be crazy. But still, all the data is pointing out we've not reached a peak yet. A next acceleration in the market could get us close to that peak, but we're not there yet. Data shows the economy is still rosy, money supply is still going up. All the things you have and that you want to see markets go up are there right now. As long as inflation doesn't go too crazy or some giant war happens or something, then the Fed's not going to increase interest rates. In fact, they're probably going to decrease them by the end of the year. This means that investors can then, of course, borrow more money for cheap stuff, and they can then go and invest in your dog coins, okay? Dog coins of the moon. No, seriously, guys. Let's start investing in some better tech. I know we like to play around with dog coins. It's fun. Bitcoin, top altcoins, top blockchains, DeFi protocols, real-world assets, coins that do something, okay? By the way, I made a separate video showcasing some crypto-specific indicators that actually show that we haven't climaxed yet for the market. So go check that out as well. I'll leave a link down below. Anyway, thanks for watching. I'll see you back in the next one. Peace.